If you're getting ready to purchase a home in Canada, you're likely going to need a mortgage. You're going to fall into one of 5 different categories of mortgage. I'm going to go over 3 of them: insured, insurable, and uninsured, but I'm going to leave out alternative and private because they warrant their own videos. My name is Cam, I'm a CPA and a licensed mortgage broker in Alberta, and I'm going to walk you through these 3 types of mortgages and the differences that you need to be aware of. First up are insured mortgages, and to keep it simple, any mortgage where you're putting less than 20% down on the property is going to be an insured mortgage. This is going to require you to purchase default insurance, which is added to the mortgage and amortized as such. And yes, this does accrue interest. Now, because these types of mortgages carry very low risk for the lender, you're purchasing insurance on it, which pays directly to the lender in the event that the mortgage defaults. Insured mortgages garner the lowest rates. This is also due in part because they're under the strictest guidelines. The file is going to be underwritten by both the lender and the insurer. This means that your debt servicing ratios, your down payment, and your credit all need to fall within insurer and lender guidelines. Exceptions are far and few in between. Second up are insurable mortgages. Insurable mortgages require 20% down, but the lender purchases that mortgage insurance on your behalf. There's no premium added to your mortgage and no additional interest charges. Another difference here is that the insurer isn't approving individual files. The lender's approving the files, bundling them together, and bulk insuring them. This means you only are underwritten by the lender. That being said, the criteria is almost identical to insured mortgages in terms of debt service ratios, down payment, and credit. And because the lender is paying the insurance premium, you can expect a slightly higher rate than an insured mortgage. The third type of mortgage is an uninsured mortgage. These also require a minimum of 20% down, but unlike insured and insurable mortgages, which are restricted to 25-year amortizations, uninsurable mortgages can often have amortizations up to 30 years. Now, these mortgages require no third-party insurance, so they are only being underwritten by the lender. And because the lender is taking on 100% of the risk, there can be sometimes leeway in terms of debt servicing ratios or how different types of income is looked at for things such as rental income. The rate is going to be slightly higher than insurable. So just to quickly recap, you've got insured with your lowest interest rate, but you're paying the insurance premium. Insurable with a slightly higher rate, but you're not paying the insurance premium. And uninsured with the highest rate of the 3 and no insurance premium whatsoever. If you want to know which type of mortgage will save you the most money in the long run, drop a comment below. If you're looking for more mortgage tips, follow me.